Oliver, we're talking about the UK's Prudential to distinguish it from the US one. Results out today. The shares have done extraordinarily well over the last year and a half. They're still going up. What did the results today tell us first?
Well, they told us that things are on track. The shares are up on the results of a fairly good set of numbers. In 2010, Prudential set itself a set of 6 targets that it wanted to reach by the end of 2013. It's got to 4 of them now. It's got 2 to go, and it says the company says it's on track. So all steady as she goes at the moment.
And in your note today, you've got an interesting hypothesis. I mean, the problem with the Pru is it's got this fantastic Asian business, it's got a US business as well, but it's also got this sort of sluggish legacy UK thing that we all know it for. What do you do if you want the Asian bit or the US bit, but you don't want the UK bit? Are there other options for investors?
There are. If you wanted to, you could replicate Prudential's portfolio with specialists in each particular area. If you only wanted the Asian bit, you could buy AIA. If you only wanted the UK bit in the asset management, you could buy Legal & General. If you only wanted the US insurance operation, you could buy MetLife or Prudential Financial. So you could build yourself a mini portfolio and replicate Prudential's business and pick and choose those bits of it that you like if you wanted.
And how does Prudential itself justify the shape of its business and owning the UK and all these other businesses together?
Well, historically, this is where the groups come from, and this is where its operations are. And to be fair to Prudential, each of its operations in isolation isn't a lot worse, in many cases better than the comparative specialist. So the collection as a whole doesn't. Each of the businesses is pretty good, but what you get from holding them together is less than clear.
And what does valuation look like after it's done so well over the last year?
Well, 17 times earnings, which is fairly pricey for an insurer. It's a little bit below AIA, the Asian specialist, above Legal & General and some of the UK players. So 17 times earnings. It's not that cheap, but you compare it to consumer goods companies that are also active in Asia, the likes of Diageo and Unilever, and they're on 17 and even more. So it's not, for a European company with exposure to Asia, it's not completely unreasonable.
Well, there's quiet breakup talk, isn't there? But it's probably going to be silenced for a good while yet, while the performance and the share price appreciation is so strong. So looks like it's going to stay as it is for a good while yet. Thank you very much for that update, Oliver.